Here is the trap most investors are sitting in right now. They are waiting for rates to come down before they buy. It feels like the disciplined move. It feels like patience. But here is what actually happens when rates drop. Every other buyer who was also waiting comes back into the market at the same time. Demand spikes, asset prices rise, cap rates compress, and the deal that was available at today's pricing is no longer available at that price. Waiting for lower rates does not reduce your risk. In many cases, it transfers the risk from your financing cost to your purchase price, and that is a trade most investors do not realize they are making. In this video, I want to show you exactly how the rate cut trap works and why the investors who move during periods of uncertainty tend to capture returns that the investors who wait simply cannot access. In the next few minutes, I'm going to break down the relationship between interest rates and asset pricing, explain cap rate compression in plain terms, and show you what a current multifamily project looks like at today's numbers versus what those same numbers could look like after a rate cycle shift. By the end, you will understand why timing in real estate is not about waiting for perfect conditions. It is about understanding what the market is about to do before everyone else acts on it. If you're new here, I'm Darren from DK Wealth and Growth, and if you've been following along, you know we focus on disciplined CMHC-eligible multifamily investing, especially in Alberta markets like Edmonton and Calgary. Stay with me until the end because I'm going to show you a specific deal example that illustrates what today's entry price could mean for your equity position once the rate environment shifts. That final section is where this all becomes concrete. Let's start with the psychology of waiting. When rates are elevated, the instinct is to pause. Financing costs more. Monthly debt service is higher. On paper, the deal looks tighter. So the investor says, I will wait until rates come down and then the numbers will work better. That logic is not wrong. Lower rates do reduce your financing cost, but it is incomplete. And incomplete logic is where expensive mistakes get made. Here is what the logic is missing. When rates drop, you are not the only person who notices. Every investor who was sitting on the sidelines, every buyer who paused, every institution that was waiting for a clearer signal, they all re-enter the market at roughly the same time. That is not a theory. That is what happened in 2020 and 2021. Rates dropped, capital flooded back in, and asset prices moved faster than most investors could react. The window closed before most people realized it had opened. So the question is not just, will my financing costs go down? The real question is, will the purchase price I am paying today still be available when rates are lower? In most cases, the answer is no. This is where understanding the mechanics matters. Real estate is priced on income. Commercial multifamily assets are valued based on the net operating income they produce relative to the cap rate. The market applies to that income. This is different from residential real estate, where emotion and comparables drive pricing. Cap rate is the key variable most investors underestimate. When interest rates are high, buyers demand higher cap rates to compensate for the higher cost of debt. That means they are willing to pay less for the same income. Asset prices stay lower. This is the environment we are in right now. When interest rates fall, buyers accept lower cap rates because their financing cost has dropped and the deal still pencils. That means they are willing to pay more for the same income. Asset prices rise. The income does not change. The price the market is willing to pay for that income does. So if you are buying a multifamily asset today at a 5.5% or 6% cap rate and the market shifts to pricing similar assets at a 4.5% or 5% cap rate after a rate cut cycle, the value of your asset has increased. Not because the rents went up, but because the market re-rated the income stream. That is cap rate compression, and it is one of the most powerful wealth creation mechanisms in commercial real estate. Let me give you a simple illustration. Imagine a multifamily building generating $300,000 in net operating income per year at a 6% cap rate, which reflects today's higher rate environment. That building is valued at $5 million. Now watch what happens when rates drop. If the market shifts and similar assets start trading at a 5% cap rate, the same building with the same $300,000 NOI is now valued at $6 million. The rents did not change, the building did not change, the market's willingness to pay for that income stream changed. That is a $1 million increase in asset value driven entirely by the rate environment. The investor who bought at today's pricing captures that gain. The investor who was waiting for lower rates before buying missed the entry point entirely and is now paying $6 million for the same asset payoff. Waiting for better financing did not save money. It cost $1 million in equity. Quick question for you. Are you currently waiting for rates to drop before making a move on multifamily? Or have you already decided that today's pricing is the opportunity? Drop it in the comments. I'm genuinely curious where people are in their thinking right now, and it helps me understand what to break down in future videos. Let me make this real with a current project. We are looking at a multifamily asset in Edmonton right now because it is CMHC eligible. We can structure it under CMHC MLI Select financing, 50-year amortization, lower insured rate, higher loan-to-value than conventional financing allows. At today's pricing, the deal already cash flows. The current cap rate environment in Edmonton means we are acquiring this asset at a price that reflects today's higher rate market. The rents are strong, the debt service is covered, and the cash-on-cash return is positive from day one. Now here is the forward-looking piece. If rates continue to come down over the next 18 to 24 months, which the Bank of Canada has been signaling, and if the market reprices similar Edmonton multifamily assets at a lower cap rate, the equity position in this deal improves significantly without any operational change. The rents do not have to increase, the building does not have to be repositioned. The rate environment does the work. You get paid twice, once through cash flow today and once through cap rate compression tomorrow. That is the structural advantage of buying during a period of uncertainty rather than waiting for certainty that everyone else can also see. Here is the real point. The investors who build serious wealth in real estate are not the ones who time the market perfectly. They are the ones who understand the cycle well enough to act while others are still waiting for a clearer signal. Right now, the signal is already there. Rates are moving. Capital is starting to come back. The window between today's pricing and tomorrow's demand is open, but it is not going to stay open indefinitely. Uncertainty is not a reason to wait. For disciplined investors, it is the reason to move. The rate cut trap is not about rates. It is about assuming that waiting is the safe option. In a market that reprices on sentiment and capital flow, waiting has a cost. It just does not show up on your bank statement until after the window has closed. If this kind of disciplined approach to multifamily investing resonates with you, make sure you subscribe to the channel. Each week, I break down how serious investors evaluate CMHC-eligible opportunities, financing structures, and real portfolio growth strategies before capital gets committed. And if you have a question you want me to cover, drop it in the comments. I read through them. If you want to see what current Alberta multifamily opportunities look like at today's pricing, click the link below. The numbers speak for themselves. Thanks for watching, and I'll see you in the next video.